first start with the Fed. What did we hear from the Fed? What did you hear from the Fed? What does it mean for the bond markets?
Yeah, so the Fed is kind of dancing along the knife edge here. Inflation is, much more under control than where we were a year ago. So we're moving in the right direction, but it's far from declaring victory. And so they're very open to being data dependent and somewhat ambiguous. And what's really unique about this cycle, David, is that the markets are embracing that ambiguity. Typically, that is a vol producer, but in this case, it's having the opposite effect. So the Fed is doing somewhat of a masterclass here on dampening market concerns, which I think is important, of course.
So, Greg, what are the bond markets telling us, if anything, about the likelihood of a recession? Because on the one hand, we got really strong economic numbers this week, surprised a lot of people. We don't see a lot of weakness in the market. At the same time, as I understand, we still are pricing in rate cuts coming up next year.
Yeah, so I think it's important to remember that the bond market's been wrong now for a better part of a year or so. So the curve has been inverted. That typically suggests that a recession is imminent. This has been the most forecasted recession that hasn't come about yet. So I think, the economy, the nominal part of the economy, GDP has been quite robust and quite strong. And I think that's surprised a lot of pundits. That's the first thing. But what's curious in the market as well is the fact that we're still seeing rate cuts priced in. So investors are quite bullish around the outlook. Risk assets are, taking off and doing quite well. But you're still seeing back-end rate cuts being priced in. And to us, we just see that as incongruent. You can't have your cake and eat it too, right? You can't have a situation where risk assets do really well and the Fed is cutting because of economic weakness. So you have to choose a side, and I think there's some confusion here on that front.
Greg, what does that tell you as a bond investor? Where do you invest, if at all, right now? Is this a good time to be in fixed income? And if so, what parts of fixed income?
Yes, so I actually think it's a great time to be in fixed income, and it's a very simple premise, and that is the income piece and the yield piece. So yields are much higher than where we were a year, 2 years ago. I think that is a fantastic starting point. So the income producing nature of fixed income really starts to assert itself. Where we see value is twofold. One is leaning against those rate cuts. So we think the hurdle for the Fed to raise interest rates, cut interest rates is really quite high. Even if there's a tweak, what's being priced in is too much in our mind. So we see value being kind of short yields here, at least in the front end. And we see a lot of value in high quality assets within fixed income. So no longer do you have to reach out the risk curve in order to achieve those income goals and targets. So we think it's a great time to invest in fixed income, where you get a lot of safe carry and a really kind of good earnings along the way.
So high quality fixed income, are you being compensated for the risk when it comes to high yield or leveraged loans?
I think that's where it's a little more tricky, David. I look at, or we look at, the parts of the high yield market. We look at the levered loan market. We look at the private credit market and really question whether you're being appropriately compensated for the risks there. So these are still, highly levered entities. There's been a lot of leverage added to capital structures over the past decade or so, kind of feasting off of low interest rates. But as those interest costs continue to kind of reset higher, right, as the cheaper debt rolls off into more expensive debt, I think that puts a lot more pressure on these companies in that segment of the market. And even without a recession, I think you'll have a higher default experience than what we've observed over the past, just called 5-7 years.
Greg, we can't let you go without talking about what happened with the Bank of Japan, because it shook a lot of people when that report came out Thursday afternoon. There was a lot of move in the markets, actually, at the time, at least for a short period of time. What did you make out of what happened, and does it have long-lasting effects?
I think it's too early to tell. So it was, in the price over the past couple of days or so. But either way, 10-year JGBs kind of jumped 10 basis points, which is a pretty big move in that market. But essentially, the Bank of Japan is drafting off of other global central banks. So we'll see. So they have this last mover advantage. And so a lot of the tightening has kind of happened away from them, and so they're just catching up. But I think it's a rationalization that's finally occurring in the Japanese markets, but I think it's a long ways to go. So, our strong sense is yields will continue to move higher in Japan, but in Japan, test that 1% threshold. But we're finally starting to see some movement out of the Bank of Japan, who's been stuck very much in this highly accommodative stance for a very long time.
Do you expect to see this result in flows back into Japan, insofar as people are taking it away from Japan because they got yields better in other parts of the world, including the United States, U.S. Treasuries? Is there a risk here it could go the other way now?
I think that risk is somewhat overblown to a degree. I think you need to see a substantial change in kind of the hedge cost. That's really highly predicated on the shape of the yield curve. We don't see a lot of movement, but it's clear that the preferred habitat for Japanese investors is in Japan, but they've been outside that jurisdiction for so long. So I think it's going to take a lot more than this move to move assets back into Japanese assets. But it is something to watch out for, but I don't expect to see a fundamental shift or a sea change by any stretch.